What's up, you guys? In this video, I'm going over 7 stocks that I am personally investing in right now. These are high risk, high reward stocks that have dropped dramatically over the last few months. As a result, they have the potential to make a lot of money. So make sure to watch this video all the way to get my reasoning and analysis on all 7 of these companies. If all goes well, you should be able to make quite a bit of money, quite a good return on your investment if you invest in these companies. So many companies have obviously been very affected by COVID-19. Some have been winners, either staying relatively the same or even going up a little bit, and some have been real losers. These losers have lost a matter of 50 to 80% of their stock value and market valuation in just the span of 1 to 2 short months. One thing that these losers have in common is that their revenues are going to near zero for at least the short-term future. That is what has really obliterated their stock prices. Investors are scared that they might not survive this pandemic and they might have to file for bankruptcy, or they'll just never recover financially from this. I mean, a lot of these people have a good point. These companies just simply cannot survive for an indefinite amount of time without revenue coming in. If there's no revenue, then these companies won't survive after a period of time when they just run out of money. A lot of these companies have liabilities that are just too high when you compare them to their current assets, which does make running out of money a real possibility when revenues go to zero. So I definitely would consider myself a pretty risky person. So personally, I will be diversifying my portfolio to include these risky stocks. In the end, yes, it is risky and I could lose my money, but I'm willing to take that risk because I think there's huge upside in these stocks. So let's get started. Number 1 is Carnival Cruise Lines, CCL. In the last 2 weeks, Carnival has received about $6 billion of additional funding, which should allow it to stay afloat for quite some time. With the Federal Reserve last week saying that they are agreeing to start buying these junk bond ETFs, this means that the government is going to start backing these loans for companies that are most affected by COVID-19, including Carnival Cruise Lines. If we take a look at their stock price, we can see that their current price is at $12.56. Their current price to earnings ratio is 4.61. And if we look at the price history, we can see that their stock price reached a value of low 50s just 2 months ago. And it actually went all the way down to $7.80 at the very beginning of April. Their current price of about $12 is still a 75% decrease from just a couple months ago. In terms of the federal bailouts, Carnival is not eligible because they are based in a foreign country for tax purposes. This means that when they do borrow money, it's very expensive and the interest rates are as high as 11.5%. We can take a look at some of the money that they have received recently, including $4 billion in 11.5% interest rate senior notes that are due in 2023, $1.95 billion in 5.75% convertible notes due in 2023, as well as issuing 62.5 million shares at $8 a piece, which equates to about $500 million in equity. Their biggest investor recently, which has made the news, has been the Saudi Arabia Public Investment Fund, who bought a total of 8.2% of the company at $8 a share. Another problem that cruise lines are facing is the fact that with their demand going down, they are still committing money to buying new ships. Carnival, for example, has $14.5 billion in new ship commitments. That is a lot of money, and with no revenue coming in for at least the next couple to 3 months, that will definitely present a problem. I did a more in-depth review on the financials of the cruise lines in my other video, so check that out if you're interested in that. But yeah, basically the cruise lines are definitely in a pretty tough spot. The goal seems to be to try and stay afloat until people start to sail again, and many naysayers think that cruising will never return to its original glory. Personally, I do disagree with this because I do believe that there is a lot of demand that will go back when these social distancing requirements are lifted. You guys might not be diehard cruisers. I mean, I'm not either, but there are certainly many diehard cruisers that are going to be returning onto these ships. I don't think the cruising industry will be shut down. I don't think these companies will go out of business because that would be a huge blow to the tourism industry. Oh, and Carnival made almost $8 billion in profit last year. Cruising as a whole has been steadily increasing as an industry for the last 10-15 years. So I definitely think it is a good and solid industry to invest in, but unfortunately right now during this pandemic, it is for sure in a tough spot. I do currently invest in CARNIVAL right now, but I will be putting more money into these cruise stocks in the next few weeks. But yeah, guys, only buy these stocks if you personally believe in them. Don't buy them because I'm saying that I am going to buy them. Okay, next up on my list, number 2 is General Electric, GE. GE is a huge company with business in the following segments: aviation, healthcare, power, energy, and a lot more. Their current stock price is trading at about $6.84, and their 52-week high was actually $13.26, with their 52-week low at $5.90 in late March. That means that its current price of about $6 to $7 is about 50% lower than its all-time high price. This huge hit for GE has largely been a result of the decrease in global air travel demand. Since GE's aviation department is such a big part of their whole overall company, that's why we've seen the stock price drop about 50% so far. But however, since aviation isn't the only thing that GE does, its stocks have not been hit as hard as some of the other plane manufacturers. So let's take a look at GE's current financials. Right now they have about $85 billion in cash and $135 billion in total current assets. Their current total liabilities right now is at $76 billion, which is not good, but also not bad. The reason why I think GE hasn't been hit as hard as companies such as Boeing is because lots of its business comes from actual services rather than products. Now, why does this matter? This matters because services generally come back faster than products do. And as a result, I do think that's why GE can make a faster improvement and comeback compared to the other plane manufacturers. Plus, it is a very well diversified company. Currently, its aviation department makes most of their money from maintenance and parts. To be specific, 61% of the revenue is from those two things. Now, while airplanes are flying less, which means less need for maintenance, they will still need maintenance performed on them. Also, right now, the demand for used jets, which are cheaper and easier to lease, is actually going up because, like I said, they are cheaper to have, and also fuel prices are getting so low right now. So these older jets, which generally aren't as fuel efficient as the brand new jets, make a lot more sense to buy now. One of the biggest incentives for airlines to actually buy these new jets was for the improved fuel economy. But right now, it doesn't matter so much because gas prices are so low. So I do think there is a lot of upside in GE stock. They are a huge company and they will find their way out of this pandemic. I don't see them going bankrupt at all, and I do think their valuation right now is quite low. Okay, next up on my list is Delta Airlines, DAL. Obviously, airlines have been down so hard as a result of this pandemic, with travel demand down up to 95%. Delta hit a 52-week high of $63.44 in January, and then they hit a 52-week low of $19.10 in March. Right now, they are trading at $24.27, and this is a 61% drop from their all-time high price. What made the news recently was when Warren Buffett sold off a large chunk of his Delta stock. I did make a video looking deeper at their financial statements to try and figure out why Warren Buffett would do this. In a nutshell though, it seems like Warren Buffett sold Delta, one, to actually get underneath 10% ownership of the company, and two, because it seemed like they did not have a lot of cash compared to their expenses. And with the federal government recently saying that airlines have to provide cash refunds to their ticket buyers, this is definitely a big blow to their current assets. Whereas before, they could just issue a credit for a future flight and hold on to that cash. Now they have to give a cash refund. However, guys, still note that he has a ton of airline stocks still. He didn't sell a majority of his shares at all. So I don't think this is him saying that airlines are completely doomed. Delta is a big corporate flyer and also a big leisure flyer as well. In terms of corporate travel, I do think that companies will start sending their employees on business trips soon. And I also think that people have been so cooped up in their homes recently that any change in the rules for social distancing will have people scrambling to travel. Yes, there will be less funds for people to travel since so many people have been laid off, but I do think that the people that travel the most have the most money and are probably not so affected by the current events. So yeah, Delta, take it as a risky investment. You could either lose this money or make a good amount of money. Long term, if they do survive, you will make a pretty penny on this stock. It really depends on just how this whole COVID-19 situation plays out. Okay, number 4 on my list is WYNN Resorts, WYNN. WYNN is a developer and operator of high-end casinos and hotels. We've seen in the news hotels and casinos getting absolutely crushed in Las Vegas, and that's really what has affected their stock price so much. WYNN is actually currently trading at $78.46 per share. share. Now, this is actually up quite a bit from March when it reached a low of the mid-30s. Its 52-week high is at $153.41, which constitutes a drop of about 50% right now. But do keep in mind that it actually did hit a drop of about 80% in March. This is a stock which is going up because of their business outlook, the possible reopening of their casinos and hotels, as well as having a better liquidity situation. Obviously, with casinos and hotels being some of the hardest hit companies due to this pandemic, we've seen their revenues drop significantly. WYNN recently raised $600 million of funding at 7.8% interest. This debt is due in 2025, which I think gives them ample time in order to get back on track. WYNN is huge. It's one of the largest publicly traded gaming corporations, and it's very diversified geographically, which explains why they have not been hit as hard as some other of these hotel and casino companies. Their balance sheet definitely shows that they have the cash to survive this pandemic. And since they are so big, they could actually possibly buy up some of these other companies, which are worth very next to nothing right now, and add them to its portfolio, which would help it in the future. Now, given the huge rise in the stock price over the last few weeks, I would actually wait a little bit before buying the stock. I think it went up way too fast, and as a result, any small amount of bad news could send shares going back down. But I will be buying this the next time I see it dip, which hopefully happens, as that will be the best buying opportunity for the stock. Even if you buy right now, in the long term, I think you should see some sizable gains. Next up on my list, number 5 is Disney. And you guys all know the company Disney. They are a diversified company with theme parks, movie studios, streaming services, and a lot more. Obviously, Disney has been hit pretty hard due to their parks being closed due to COVID-19. Their current stock price is at $106.63. They actually hit $140 in February, but then dropped to a low of $80 in March. And now it's back up another 20% to around $100. This means that we have seen a total drop of about 35%, making it actually not that big of a loser compared to some of the other stocks on this list. One reason why the stock is cool is because it actually currently has a dividend of 1.65%. We also need to look beyond just their parks being closed and the cruises being closed as well. Yes, these have a big impact, but Disney also has Disney Plus, which is their new streaming service. This is a well-positioned company that is going to make a lot of money. In fact, now that people are staying home and streaming lots and lots of content, I think Disney Plus is going to do extremely well. Their financials show that they make about $10 billion in earnings per year for at least the last few years, with revenue actually getting all the way up to $70 billion last year. Right now, they are being hit hard, and they are losing about $30 million each and every day. But Disney will survive this. There's no question about it. They recently actually took on about $7 billion of debt to help them ride out this pandemic. Right now, they have about $12 billion of unused revolving credit available for them. They also have about $5.5 billion in cash, which means they should be able to ride out this pandemic no problem. Even if they're currently losing $30 million a day, they will be able to survive for at least the next few years. Personally, I think Disney is not even close to going out of business. So with this 35% sale that's going on right now, I think it is a good time to buy. But I do think it can go down more depending on this whole virus timeline, depending on how much longer the parks are closed and the revenues for the next few months. Personally, I will be averaging down on this stock. Okay, number 6 on my list is Ruth's Hospitality Group. RUTH. This is a restaurant company that's focused on American steakhouse restaurants. Currently, they are trading at $8.50 per share. They reached a 52-week high of $27.14 and a 52-week low of just $8. So yeah, right now it is near its bottom and it is down 70% from its all-time high. In the news, yes, they were just approved for a $20 million Paycheck Protection Program loan. And that money, since most of it should be forgivable, will help them out a lot. Currently, they do have 159 locations across the country, making them a big player in the steakhouse industry. As of April 10, they had $86.6 million in cash, but they do have some liquidity issues, as many restaurants do during this time. Ruth's Hospitality Group has seen steady growth increases over the last 4 years, with over $450 million in revenue last year. I personally don't think that COVID-19 will end this company. I think that they are doing what they can to ensure that they have good liquidity, and I do think that the loans that they're getting will help them survive. Yes, their profits profits in the next year will continue to hurt, but in the long run, this business will likely do just fine. American people love their beef, love their steak, and Ruth's has just been a staple in this whole industry for quite some time now. So yes, right now I do think that the stock is undervalued, and I think there is potential for it to grow quite a bit in the future. Okay, last up on my list, number 7 is Royal Caribbean, RCL. Like I said earlier in this video when I went over Carnival, I am a big believer in the cruising industry. Royal Caribbean is one of the biggest cruise lines along with Carnival and Norwegian. I've been on their cruises, and in fact, I actually like them better than Carnival. Right now, they currently are trading at $37.39 per share. They did reach a 52-week high of $135.32. And it's crazy, but they did drop all the way down to $19.25. Now I'm kicking myself because I wish I had bought some of the stock at such a low price. And right now, based on their current valuation, their PE ratio is 4.18. So yeah, $37 down from a high of $135. That's like a 70% drop. So yes, RCL is just as affected by the CDC ban of 100 days, just like Carnival and Norwegian, but RCL has actually extended this all the way until June 12th, 2020. Like Carnival, Royal Caribbean won't fully recover anytime soon. $13.9 billion in new ship commitments, which is not good, seeing all this decrease in demand. Pretty much, this is a risky buy that only makes sense if you are a believer in the cruise industry. If you think Royal Caribbean will stay afloat, then this is definitely a buy. If you think all the cruise lines are going to go out of business as a result of COVID-19, then don't buy the stock, and don't buy any of the other cruise stocks either. Of all the companies on this list, the cruise lines are the most risky, but in my opinion, they also have the biggest potential for a return on your investment. I am a long-term believer, and I don't think this pandemic will have these social distancing rules for that much longer. And people will start to be able to go out and do their own thing. And in return, cruising will slowly get better. It's a great industry, and it's had very good growth over the last 10, 15 years. So that is why I am still a believer in cruises when many people are not. So you guys, those are my 7 top picks for risky investments that have a huge return on your investment potential. I really urge you guys, don't only buy these risky stocks. Diversify them with some dividend stocks, with some index funds, or stocks from companies that have weathered this pandemic really well, that have actually increased in value. I've made other videos about my choices for safer bets, so definitely check those videos out. But if you do have some risk tolerance and you do have some money that you can afford to lose, definitely consider some of these stocks. Like I say in all my videos, make sure to do your own due diligence. Do your own research by yourself. It's really important to understand what you are getting into when you invest in a company. These are just my opinions, so don't take them as fact. Just take them as a source of information and use it to kind of guide your own investment decisions. I really hope this video helped you guys out. Make sure to leave a like and also subscribe to my channel if you want to see more videos just like this. Share this video with a friend who loves risky stocks, as they might find some of these companies very enticing. Okay, that's it for today, you guys. Thanks so much for watching, and I'll see you guys in the next video. Peace.